Welcome to The Explainer. Today, we are going to tackle a word that, let's be honest, causes a lot of anxiety and confusion in finance: risk. But here's the thing: by the end of this, you'll see how to look at risk not as some big, scary threat, but actually as a tool. All right, let's just dive right in. And we're going to start by challenging a core assumption you probably have about what risk even means. Because, spoiler alert, it's probably not what you think. So, when you hear the word risk, what pops into your head? For most of us, it's just pure danger, right? Like the chance of something terrible happening, maybe a car accident. It's this completely negative idea. But here's the twist. In the world of investing, the meaning of risk is, well, it's different. It's not just about the chance of losing money. It's really about the range of possible outcomes. Yeah, that could be negative for sure, but it could also just be less positive than you were hoping for. The real key here is unpredictability. So if there's one thing to get from this first part, it's this. In finance, risk pretty much equals variability. An asset is risky if its returns are all over the place, totally inconsistent. And a so-called risk-free asset, well, that's just the opposite. It gives you a super predictable, consistent return, year after year. Okay, so now that we've got this new definition, risk is variability, let's get into the really interesting part: why you might actually want to embrace it. I know, sounds crazy, right? Think about it like this. Imagine you have an investment with very little fluctuation, so very little risk. It's super reliable, it's steady, but what's the catch? The trade-off is that it's probably going to give you a pretty modest return on your money. Safe, but maybe a little boring. And that right there is the core bargain of investing. It's the fundamental trade-off. If you want a shot at getting higher returns, you simply have to accept a wider range of possible outcomes. You have to be okay with more of that variability we were just talking about. You know, this is one of the most fundamental principles in all of investing. The market, generally speaking, rewards investors who are willing to stomach more uncertainty. You get compensated with potentially higher returns for taking on that variability. It's the name of the game. All right, now we're getting to what I think is the most important concept in this entire explainer. You have to get this. Not all risk is created equal. In fact, there are two very, very different kinds of risk. Okay, so we can basically split all investment risk into two big buckets. In the first bucket, you've got the risk that affects everyone. This is the stuff you just can't control. And in the second bucket, you have the risk that's specific to just one company or one industry. And that's the risk you can actually do something about. So that first bucket is called systematic risk. Think of it like the economic weather. When the government raises interest rates or when inflation suddenly spikes, it pretty much affects every company out there. It's like a rising tide that lifts or lowers all boats. You can't diversify this away because it's a force that just hits everything at once. Now, that second bucket is unsystematic risk. And this stuff is totally company specific. A CEO suddenly resigns, a factory has a major issue, a huge competitor launches a game-changing product. I mean, these are all bad things for that one company, but they don't necessarily drag down the entire market. And here's the key. You can manage this type of risk by, you guessed it, not putting all your eggs in one basket. Okay, so let's make this more concrete. How do these two types of risk actually show up in the real world? We're going to do a quick tour of the most common risks you'll run into. And let's start with the big ones, the systematic risks that you just can't avoid. First up is market risk. And yeah, this is a big one. It's a classic systematic risk. This is all about the overall mood of the market. You know, the psychology that drives those big bull and bear markets. Sometimes prices just go up or down because of widespread optimism or pessimism, and it drags almost all stocks along for the ride, regardless of how well an individual company is doing. Next up, another heavy hitter in the systematic risk category: interest rate risk. Now, this one is a huge deal for bonds. Here's how it works. When central banks raise interest rates, those old bonds with their lower rates suddenly look a lot less attractive. So what happens? Their price tends to fall. It's like a seesaw. One goes up, the other goes down. And then you've got what I call the silent killer: inflation risk. This is the sneaky danger that the purchasing power of your hard-earned money will just get eaten away over time. Think about it. If your investment returns 5%, but inflation is running at 6%, you're actually losing buying power. You're going backwards. And yeah, this is another one of those systematic risks that hits absolutely everyone. Okay, so those are the big market-wide forces. Now let's shift gears and talk about unsystematic risk. Remember, this is the kind you can actually manage. So first up is business risk. This is all tied to a specific company or a specific industry. A hot new competitor enters the market, or a new government regulation comes out that only affects, I don't know, trucking companies. This is totally diversifiable. And finally, let's talk about liquidity risk. Ever heard of this one? It's the danger of being stuck with an asset you can't sell quickly when you really need the cash. Some investments, like maybe real estate or stock in a tiny, obscure company, can be super hard to unload without taking a massive price cut. This is also, for the most part, an unsystematic risk. So, what do we do with all this information? What's the practical takeaway here? How does knowing about all these different types of risk actually make you a smarter, more confident investor? Well, it all starts with this really simple but incredibly powerful idea. The total risk or total variability of your portfolio is just a combination of two things: the market-wide risk you can't control, plus the company-specific risk that you can. And this understanding gives us a super clear three-step strategy. Step 1, accept that systematic risk is just part of the game. You can't change it. Step 2, make sure you're getting compensated for taking it on. And step 3, use diversification to get rid of as much of that company-specific, unsystematic risk as you possibly can. See how that works? It moves you away from just being scared of risk to having a real strategic focus. So the ultimate takeaway here is a complete mindset shift. A smart investor doesn't run away from risk. No way. They analyze it. They break it down into its different parts. And then they make absolutely sure they're getting paid fairly for the risks they decide to take on. So by breaking down this giant, scary monster that we call risk into its actual manageable parts, the systematic and the unsystematic, you can finally see it for what it really is. It's not just a threat to be feared, it's a puzzle to be solved.